Be Wealthy and Smart, episode 622.
Step into a world of wealth and financial freedom without budgets, boredom, or bosses on Be Wealthy and Smart. And now, here's your host, Linda P. Jones.
Welcome to Be Wealthy and Smart. I'm Linda P. Jones, America's Wealth Mentor, empowering women and men worldwide to financial freedom. On today's show, we're going to talk about what's going on with repos. Now, you might not be familiar with this term, repos. It means repurchase agreement. But I'll tell you, there's a lot of scuttlebutt and gossiping and whispering going on in the financial markets. And people want to know what is happening because there is a very large volume of dollars that are going toward the repo market that is causing a lot of eyebrows to be raised. And yet nobody from the Federal Reserve is talking about it. So first of all, what is a repurchase agreement? Well, Investopedia says a repurchase agreement, or repo, is a form of short-term borrowing for dealers in government securities. In the case of a repo, a dealer sells government securities to investors, usually on an overnight basis, and buys them back the following day. Now, this usually occurs between banks. So banks often loan money to each other overnight, often at a very low rate. But recently, this rate around 2% spiked to about 10%. So it went up 5 times the usual cost for a bank to loan money to another bank. The Federal Reserve opened a window and was allowing banks to come to the window if they needed money. And literally hundreds of billions of dollars have been given to banks through this window. So people want to know what's going on. And the Federal Reserve has been very, very quiet for more than a week now. They've scheduled repo operations for every business day until October 10th. And I guess what's scaring people is that we saw a spike like this right before the 2008 crisis. So here's what a CNBC article said about it. This was written by Patty Daum on CNBC.com. And it says, the Fed's fix of the crucial repo lending market for banks will be put to the test on Monday. That's today. The Federal Reserve has used open market operations to soothe the short-term funding market, and now its temporary fix faces a test as the third quarter ends. The Fed has used overnight and 14-day market operations to stabilize the repo market, used by financial institutions to fund themselves on a short-term basis. The Fed was reacting to a sudden spike in rates September 16th and 17th, and it's under pressure to permanently resolve the issue, which seems to stem from a cash crunch in the overnight borrowing market rather than a credit crisis. During the temporary panic in the overnight funds market, rates spiked to as high as 10%, and the Fed's own benchmark federal funds rate briefly traded at 2.3%, a 0.05% above the Fed's target rate on September 17th. The weighted average Treasury repo rate in the Fed's operation was at a subdued 1.8% on Friday. In the past several days, the Fed expanded its facilities as they met high demand, but by Friday, both its $100 billion overnight repo and its $60 billion 14-day were undersubscribed. Clearly, things are calmer than they were last week, but there are still definite questions and concerns. We still do have relatively elevated rates, whether it's in treasuries or mortgages this week, said Ralph Axel, U.S. rates strategist at Bank of America Merrill Lynch. It's still up for debate whether or not adding additional reserves at this point will matter for funding issues through the end of the year. Repo is a corner of the financial markets that is obscure to most people. It is where institutions go when they need short-term cash, exchanging some collateral, like treasuries or mortgage securities, for a short-term loan. It is considered the plumbing of Wall Street, and the worry is if it doesn't work or shows stress, then it could lead to real stress in the financial system. The third quarter winds down on Monday, and the overnight repo market, as it's known, could face strong demand as banks pull back on lending to spruce up their balance sheets to close out the quarter. Market pros will be watching how much the Fed facility is used and whether interest rates become elevated again. There should also be high demand due to cash needs related to the settlement of $113 billion in treasuries auctioned Tuesday, Wednesday, and Thursday. If things get messy, the Fed will bump it up. If the Fed is getting this worked up about the end of Q3, it seems the Fed will take aggressive measures to make sure year-end is okay, said Michael Schumacher, Director, Rate Strategy at Wells Fargo. High yields in repo make it difficult for buyers to maintain the types of margins they need on certain types of investments. Hedge funds are one customer for the repo market. They need repo. If repo becomes tougher and gets to be more expensive, that makes it more difficult for a hedge fund to put on a position. Major banks, who are the primary dealers, are the only institutions that can use the Fed facility, and they then would be lenders to other institutions that need capital. But they could also serve as a bottleneck since they are not required to report how the short-term funds are being used. The banks do a lot of work to make their balance sheets look particularly safe when they're going to publish their quarterly statements. That means they don't want to show a tremendous amount of short-term liabilities on their balance sheet. It's a normal end-of-quarter phenomena, said Odeon Capital Group bank analyst Richard Beauvais. There was also a big improvement in another important rate, the Secured Overnight Funding Rate, or SOFR. Secured Overnight Funding Rate, as it's known, was at 1.85% Thursday, down from 5.25% on September 17th and 2.01% on Wednesday. That means on September 17th, 5.25% was the median rate for $1.2 trillion in short-term funding transactions. The Secured Overnight Funding Rate affects floating rates on about $285 billion outstanding in corporate and other loans. Beauvais said it appears the issues in the market were possibly seasonal, but for some reason the demand and supply were imbalanced, and it's still not clear why there was such demand for cash. That has led for calls for the Fed to address the situation, which popped up unexpectedly mid-September, not at quarter end or during a period of financial market volatility. There have been other brief periods of stress, most particularly last December when there was a violent sell-off in the stock market. There's always been this problem between the Fed's monetary policy and the Fed's bank supervision policy. The bank supervision policy since 2012 have been fairly clear about repos, said Beauvais. The Fed didn't want the banks to be involved in that market. It set up rules. What the rules did was to force the banks to lengthen the maturities on their debt and reduce the amount of funds they make available in the repo market. That resulted in less support from banks than in the past. Strategists said the regulatory changes are part of the issue. The repo operations of banks now show up against their capital ratio and could affect the amount of capital versus leverage they would be expected to hold by regulators. In the fourth quarter, that becomes especially acute as banks seek to improve year-end capital ratios. The Fed changed the rules when the Dodd-Frank legislation for bank reform was adopted after the financial crisis, which was the last time the Fed had to intervene in the repo market. The Fed is expected to address the issue of the cash crunch when it meets October 29th and 30th, and it should discuss some of the solutions it has considered in the past, like a standing repo facility where it would be prepared to intervene every day. Another solution would be to expand its balance sheet, and the talk is that it would consider some short-term quantitative easing to expand its holdings of treasuries. The New York Fed runs market operations for the Federal Open Market Committee, and it was able to steady the market once it began operations on September 17th. Strategists say Monday's outcome will be important to watch to see how much demand there is for capital, plus at what rate it is being accepted. A sharp move up in rates would be a warning that the Fed needs to keep its hand in the market into the fourth quarter as it works up a long-term solution. I think it will be fine because the New York Fed has its eye on the issue. I'm not worried, said Joseph Gagnon, Senior Fellow at Peterson Institute for International Economics. I wouldn't want to overstate the problem. As long as they're responding, they're able to keep it under control. Our point is they should have a system in place that is more automatic so these issues don't come back and they don't have to keep responding. The key one is a standing repo facility where people who want to borrow can borrow at a rate the Fed sets. They should also increase reserves and the balance sheet. Strategists trying to get to the bottom of the period of stress blamed the spike last week on a perfect storm of events. There was a surge in demand from companies making tax payments, as well as investors that had to make settlement on a large amount of treasuries. But one unexpected event was the attack on Saudi Aramco, which knocked out half of its energy production. That is believed to have triggered some investors to seek the safety of cash, and it also prompted speculation that Saudi Arabia itself was seeking cash as a temporary precaution. End of article. Well, you can see there's a lot of speculation and it's clear as mud. The Fed has not commented on this, and they're trying to keep things calm and under control, and that's the right way to be. It looks like we're not going to get any clarity on this by the Fed until the end of October. And they have said that they will continue these operations and continue providing liquidity until October 10th. So what happens between October 10th and October 29th when they meet? I don't know. But this is what they've told us so far. So we'll continue to watch and report on it to you. And if you're asking if there's anything you need to do in response to this, I would refer you back to my podcast about things to do before the end of the year. There are some strategies in there that I think would be good, like keeping some more cash on hand, having enough for a few days grocery, gasoline, things like that. I always think is a smart thing to do. But don't panic, stay calm. I'm sure more news will come out about this and we'll find out some details. Oftentimes they wait until a crisis is over and then they tell us in past tense what happened, but they don't like to talk about it while it's still going on. So we'll see how things go, and that will likely determine how soon we hear about it from any official statement. If not, then our first statement might be at the Fed meeting October 29th and 30th. As always, I'll post a link to this article in the show notes. If you haven't yet subscribed to Be Wealthy and Smart, hit the subscribe button and you'll be updated as soon as new podcasts are available. Don't forget, we have all of my podcasts at lindapjones.com/podcasts. That's all for today. Until next time, live the good life and be wealthy and smart.
Thank you for listening to Be Wealthy and Smart with Linda P. Jones. Share the wealth and tell your family and friends about the show. Check out our website, blog, and social media for more riches at www.bewealthyandsmart.com.